I'm just going to touch base on a quick housekeeping items before we dive into the meat of the presentation. Really quickly, if you weren't on the last webinar that we did last month, my name is Zach Holcomb, and if you haven't had the opportunity to meet me yet, I joined the Reliance family about a year ago on the marketing team, helping run point on all of our live events, experiences, and now these online webinars that we're doing on a monthly basis. So today we're going to have a short session on tax pitfalls in retirement and what you should be thinking about in 2025 and going forward. We anticipate this session is probably going to last around 40 to 45 minutes max, so you can get back to your afternoon relatively quickly. We're going to be talking about tax smart opportunities right now that can help your retirement savings last significantly longer. But one thing I want to make absolutely clear before Grace dives in today is about information only and not specific advice. For us here at Reliance Financial Partners as fiduciaries, to give you specific advice, we need to have a full, clear, and black and white understanding of your specific situation. So at the end of the presentation, we're going to be offering you the opportunity for you to engage and chat with our team. If you are a current client and you have some questions about the material presented today, we will offer you the opportunity to have a conversation or a quick phone call with us. But if you're not currently working with Reliance Financial Partners and you would like a second opinion on your situation, maybe you're looking to work with an advisor for the first time, potentially you want to explore working with somebody new, or maybe you just have a question about the information presented today and how it can impact your situation, you're also going to have an opportunity to chat with our team. And we'll let you know what that looks like as we go throughout the presentation. But before I pass the baton over to today's presenter, Grace Succi, she's a financial advisor here at Reliance. I want to share a little background about her career if you don't know about her. She has over 30 years experience spanning financial service companies and elder law. Grace has worked at TD Bank, JP Morgan Chase, Hurley Elder Care Law, and now Reliance Financial Partners, where she helps hundreds of our clients navigate uncertainty with clarity and confidence. And she's thrilled to be joining us for another webinar presentation today. So I think Grace has given me the signal that she's ready to go. Want to take it over?
All right. Thanks, Zach. All right. Well, thanks for coming, everyone. I'm so glad everyone's here to talk about something that is near and dear to all of our hearts. Don't we all love taxes? Oh, wait, we don't? Okay. Well,
I
what
love taxes.
I mean, what we're here to talk about is some pitfalls and things that we can do to kind of try to save money so you can keep more of your money in your pocket. So before we get started, this is just a little bit about our firm. We were founded in 2012. This is a picture of our entire team. And we are independent financial professionals, which means that our only allegiance is to our clients. We are true fiduciaries. So without further ado, I'm going to go ahead and just jump right in here. So some of the things that we're going to cover today is we're going to, one, understand the most common tax traps that retirees fall into. Two, learn some strategies to reduce taxable income in retirement. And three, discover how tax laws impact Social Security, RMDs, Medicare, and more. So, how do we get into taxes? Well, in order to have taxes, we have some income. And so these are some of the common sources of income that people see in retirement. We've got our Social Security, our pensions, IRAs, 401ks. We also have Roth accounts, which are after tax money. So those are not taxable upon withdrawal. You can also have taxes or income from your brokerage accounts through capital gains and dividends. Also, there's interest. There's annuities, rental income, and part-time work. So all kinds of ways that we can make money, which means all kinds of ways that Uncle Sam can put their little hand in our pocket. So let's go over our first tax pitfall. So RMDs. So a lot of people ask me, I'll say this is like one of the most common calls we get here in the office is it time to take my RMD? I think I'm old enough. How do I do it? How am I taxed? All of these things. So I'm just going to go ahead and nip that right in the bud here. So required minimum distributions start at age 73 as of 2025. They will actually be changing that eventually, but all we need to worry about right now is that it's 73. So what that essentially means is that the government is forcing you to take your money out of accounts that were not taxed previously. They're like, hey, now we want some of our money, so start taking that. Um, RMDs are fully taxable as ordinary income. They can push you into a higher tax bracket. So if you're trying to be strategic about things, a lot of people, when I ask them what's your income, they'll tell me, oh, I have a pension, I have Social Security, I have all of these things. Many people forget to mention the RMDs as part of their annual income, which is super important when we're doing tax planning for people. Um, just an FYI, if you are 73, you can defer your first RMD until April of the following year. However, keep in mind, if you do that, you'll have to take two in the same year. So you want to make sure if you're making that decision, it's being made strategically. You can also take the RMD at any time during the tax year, and you don't have to wait for your birthday. And the RMD is based on the 12/31 balance of the prior year and the life expectancy. So that's how this is calculated. One little tip is if you accidentally miss an RMD, which I hope doesn't happen because there are penalties if you miss an RMD, but there is a form that you may be able to fill out to ask the IRS for forgiveness. So if you've noticed that oh my God, I totally forgot to take it next year, or they didn't send it to me, or whatever that is, reach out to your tax professional to see if they can assist you with that form. And inherited IRAs are treated a little bit differently. So if you inherit an IRA from a non-spouse family member, a parent, or in some cases, I've seen people inherit from a child, which is very sad, but just non-spouse, you have to follow the 10-year rule. This was enacted with the Secure Act of 2020. You used to be able to stretch IRAs, but now you have to deplete the entire account within 10 years. And if the person you have inherited from was already taking RMDs, you must continue to take an annual RMD. So the government is like, nope, no breaks there, basically. So tax pitfall number 2 is the Social Security surprise. So some people don't realize that up to 85% of your Social Security benefits could be taxable. And just as an FYI, if you are still working and you're taking Social Security, your benefits may be reduced if you're making more than roughly 22,000 in that neighborhood. So you have to be very careful when making that decision as far as what your other income is. And bracket creeps can happen fast, you can go into the next tax bracket, pretty easily if you're not watching what's happening, basically. So essentially, you want to make sure that you're aware of what the scenario is with your Social Security taxation and make a decision as to whether or not you want to withhold taxes. There are penalties if you don't withhold enough taxes during the year. So you want to be super aware of that. This is just showing you what the various tax brackets are, so that you can kind of see single filers, married, joint, and heads of households. Always good information to share, and this is for 2025. Our next tax pitfall would be Medicare IRMA, which basically means if you have higher income, you may be responsible for paying more Medicare premiums. And that's for Part B and Part D, which is the prescription section of Medicare. Now, IRMA surcharges could sneak up on you. It can happen accidentally. You might have sold a property and had some capital gains. It might be something you're not even thinking about. And the thing that's kind of scary is there's a 2-year look back. So what you did in 2023 affects you in 2025. So you want to be super aware so that you can be prepared. Then what they do is they review it on an annual basis. Now, you could be doing some great planning with, your financial advisor, etc. But just keep in mind, if you're doing Roth conversions or if you're doing, if you have high RMDs, this can also push you into that scenario where you're paying more for Medicare. And I just wanted to show you guys the current brackets here. So 2 years ago, for example, if you're married and you had more than $212,000 in taxable income, you will see a rise to your Medicare premiums and your Part D premiums. Tax pitfall number 4 would be capital gains taxes or traps. So selling appreciated assets can cause capital gains taxes. And the length of time that you've held those assets makes a difference. You have short-term versus long-term capital gains, and those are treated differently. So what can be a capital gain? It could be you sell a piece of investment property. It could be you bought Apple stock, 20 years ago and you're selling it and it's got a gain to it. These are all things that can generate capital gains. You could decide, oh, I want to buy a stock, some Walmart, just making that up. And oh, it went up 3 weeks later. I'm going to sell it. Well, that would be a short-term capital gain. So generally speaking, your long-term capital gains are going to be assets that have been held longer than a year. Your short-term capital gains are going to be assets held less than a year. If you have a short-term capital gain, that is taxed at your ordinary income rate. Long-term capital gains can receive more favorable tax treatment. Most people will fall into the 15% range. It is tiered via your income. But in some cases, you could even pay 0 depending on what your income is. So for example, if you're married filing jointly and you have less than $96,700 in taxable income, you actually have some room for some capital gains. So if you're working with a financial advisor, they should be reviewing your tax return or talking to you in detail about your income to see if there's any opportunities there to realize some gains at no charge. Capital gains can bump you into a higher tax bracket. And one thing I talk to my clients a lot about is what's called tax loss harvesting, which essentially means that if you need to take a withdrawal from a non-qualified account, and that means not an IRA, let's say you need $10,000. Well, it's a good idea for us as your financial advisor to look and see what the cost basis is of all of your investments and figure out the most efficient way to do that. We can offset some gains with losses to help reduce any potential capital gains taxes for you. Tax pitfall number 5. State and local taxes. So, oh, I love the state of Texas. We have no state income tax. Love that. Love that for people in Wyoming and Florida. Amazing. However, if you're relocating, don't forget, you may have some state taxes where you're going. My great home state of Connecticut, very highly taxed. Not pleasant. If I was going to move home, that would be something that I would have to seriously consider. But don't assume just because you're in a low tax state that that means no tax. So look at the total picture when you're making decisions. So for example, here in Texas, in my opinion, we have very high property taxes. You also want to look at sales taxes and, what the state income tax is. It's just something to be aware of that people may not think about that I want to mention. Tax pitfall number 6 is what we call, oh God, my light just turned off. Jeez. I'm not moving. Tax pitfall number 6 is the widow's penalty. This is what we call the penalty. It's not really a penalty per se, but what some people don't think about is if you have a married couple and we look at the tax brackets, which we will in a minute, you could see that they're much higher. So if one person passes away and the married couple becomes a single person, they're going to be taxed at a different rate. So you have a big shrink in your bracket there. And so that's why it's so important to look at planning opportunities while you're in a more favorable bracket. That could be through Roth conversions, which means taking some of your traditional IRA money and moving it to Roth so that it can be withdrawn tax-free later. Or you can even structure things in trusts as well. And this is just, again, showing you the difference in the tax bracket. So you may have a married couple, 22% bracket, 206,700. Well, that drops to 103,350 for a single filer. That's a huge difference. And you can see where it can become problematic later. So always want to do planning in advance to look for these events.
That's super scary seeing that
I know,
drop.
right? Tax pitfall number 7 are Roth conversions gone wrong. Now, Roth conversions can be a very beneficial thing, but timing is the key. So you don't want to do it when it's not favorable from an income perspective. So for example, I may have someone coming to me now planning for retirement, but they're still working. So many times what I'll say is, okay, we can look at some strategic Roth conversions for you, but we're not really going to go down that road until you retire and your income is less, because you do pay taxes on the money that you withdraw from your traditional IRA when you do a Roth conversion. So that doesn't mean you'll never pay taxes on it. You will pay taxes on it up front. The theory being that, do we think taxes are going to go down in 20 years? Probably not. I mean, Zach might think that. Do you think that, Zach?
Maybe.
But but we want to make sure we're timing it out appropriately. We also want to be mindful of where you are in your tax brackets. So many times we'll kind of talk with our clients and say, well, where do you fall and what are you comfortable going to? Are we good going to the 22%? Or, where do we want to actually bring you to, essentially? And make sure they understand what the scenario is. We also want to be aware of those Medicare surcharges as well. So kind of the sweet spot is if you've retired and you're waiting on some income to start, or you're waiting on Social Security, being in your low income years before your RMDs start is a good time to start looking at it. And we review it annually with our clients as well. Speaking of which, if you are client, connection, prospect, and you have questions on anything that I've gone over so far, let's chat. I can't give you specific advice on this webinar, but you do have opportunity by filling out that contact sheet to have a conversation with us.
Yep. Yeah, we'll send this out after the webinar is over as well. But if you want to just submit a question right now, or if you want to chat with a member of our team, if you just go to reliancefinancialpartners.com/contact, or if you just go to our main website and click meet with us, it'll bring you right to this form where you can just pop in your name, email, phone number, and send a brief message around any questions you have or anything you'd like to potentially discuss with our team. We're happy to reach back out to you and see what time we can get scheduled with you.
Mm-hmm. And some of the strategies that we use is we look to kind of make sure we're diversifying income sources such as tax deferred income, taxable and tax-free income, and making sure that we're helping you maximize that. We assist with strategic Roth conversions. Now, we're not looking to replace your CPA. We work alongside professionals to assist with this type of thing. We do tax planning, we don't do tax returns. Another thing that I love to tell people about is qualified charitable distributions, or QCDs. If you're donating money to charity, and right now the standard deduction is pretty high, you may not be able to receive the benefit of writing off those deductions. Well, one way that you can do that is you can, if you're over 70 and a half, you can do what's called a qualified charitable distribution, which is essentially, let's say you take $5,000 from your IRA and you send it directly to the charity, then that is reduced. That is not counted as income for you. So if you have a $10,000 IRA withdrawal, you send $5,000 of it to SNPSA, an animal rescue. That's what I would do. As long as it's going directly to SNPSA, it can never touch your hand. It cannot go in the account. You can then, on my tax return, I'm reporting 5,000 basically. So I've seen people deduct and not be able to see the benefit of that. And that's something that I suggest. In fact, we assist with it. So all you need to do is tell us what the name, address, everything with your charity, and we'll help you do that. So if you're on here and you're a client and you have the desire, then please let us know and we're happy to help. Social Security timing strategies. So we want to make sure that we want you to enjoy your money. We want you to take Social Security in a way that works for you. But for example, if you're still working, it might make sense to delay so you're not giving up that extra money. Or we can show you over time how much, if you wait till full retirement age, what benefit will that be for you? Everyone really has a different philosophy about that, and we work with your philosophy and make sure that you have the information. I can definitely see people wanting to take it early and enjoy that money. You paid into it and let's go use it. You have somebody like my mom who passed away at 67 and she got like a couple checks and never got to really enjoy it. So I want to make sure that when we're guiding you, we're doing what works for you and that you have the information to make a good decision. We also want to make sure that we coordinate withdrawals and make sure that you're handling your money in the most tax efficient manner. So if we are managing your non-taxable account, your IRAs, etc., and you need to make a withdrawal, we always look to see what the most tax efficient way to do that is. Do you have some losses in your taxable account that will make this a non-event from a tax perspective? We arm you with the information. But these are all things that your advisor should be looking at. If you're making a phone call saying, I want to withdraw, $20,000, this should be a discussion that is had, especially if you have multiple accounts and multiple types of accounts. Okay, and now I'm going to talk a little bit about taxation to beneficiaries on various types of accounts. So if you inherit an IRA, or if you leave an IRA to children, family members, when they take withdrawals from that traditional IRA, they are distributed as ordinary income. If your beneficiary is under the age of 59 and a half, they do not incur that 10% tax penalty. But also keep in mind that non-spouse beneficiaries must completely empty the account within 10 years. So they will likely need tax strategies if it's a large account. If you leave Roth IRAs to your beneficiaries, their distributions are tax-free, but they still must take the distributions within 10 years or empty the account within 10 years. Why is this important? Well, the government doesn't want you to enjoy that tax-free growth forever. If this is super important and near and dear to my heart as someone who worked in elder law, if you have a trust as a beneficiary of your retirement account, you have to understand that trusts have complex rules. And I'm not saying that you shouldn't do it. I'm just saying you need to have a discussion with your attorney to make sure that your trust is set up to efficiently handle IRAs. Not every trust is. So that is definitely a discussion to be had. I like to coach people through having those discussions with their attorneys. Okay, next, taxation of an inherited home or real estate. So if you inherit a house, you get what's called a step up in basis, which means if my mom bought her house for $100,000 and when she died, it was worth $300,000 and I inherit it, my new cost basis, it's $300,000. So basically, I can sell that house and pay little to no gains because I'm getting that step up at death if I sell it quickly, of course. If I keep that house and I sell it later for 500,000, I'm only going to pay on the date of death basis and what it's earned since then. So many clients desire to give their property to a family member, add their child to the house, etc., while they're still alive. Those conversations should be thought through because if you give an asset to somebody while you're alive, they will get your original basis. So proceed with caution. Same thing with non-qualified taxable brokerage accounts. So that Apple stock that you might have bought for $10,000, it's now worth $100,000. You pass away, your beneficiaries get a step up in basis. Beneficiaries will pay capital gains on the gains after the date of death. And they're not necessarily paying taxes just for inheriting the account. Not necessarily. But if you give a stock, same rules that I just talked about on the house apply. Now, one idea is if you want to give a stock, let's say you have that Apple, you bought it for 50, it's worth 300 now. You want to give it to a charity. Well, if you give it in kind, then the charity doesn't pay taxes on it. So that could be an efficient way to handle that. Again, this is all about the coaching that we do as you're making financial decisions. Bank accounts and CDs. So the inherited value may, depending on how much you have, pass tax-free to beneficiaries. Any interest earned after the date of death, of course, is taxable. These can be passed to the beneficiary via beneficiary designation or probate, but just keep the ownership in mind when titling accounts. So this is not necessarily related to taxes, but just a good practice. If you have a beneficiary or a joint owner on an account or a joint owner with rights of survivorship, that will trump whatever in your will or trust. So just make sure if you have beneficiaries set, they are the way that you want them, because that's going to come first. And really, once you pass away, there's not much that can be done. Now, another little tip that is non-tax related that I love to give people is if you have beneficiary designations on your assets, it's a great idea to have a binder or some sort of folder with written proof of that in a book or some sort of quick place where your beneficiaries can grab it. With bank mergers and things like that, you just want to make sure that, everything, the records are retained. Sometimes the burden of proof, I've seen it actually fall on the client in my old life at the law firm. So I like to mention that to people. Life insurance and estate gift taxes. Well, proceeds of life insurance are typically tax-free. The current federal estate tax lifetime exclusion is 13.9 million per person. It's also the gift tax exclusion. These are all up for review. Oh my God, the light turned off again. These are all up for review in 2025. The annual gift exclusion is 19,000 per recipient, so you can give money away, 19,000 per recipient to reduce estate taxes. You will have to file an informational return. That doesn't mean anyone's paying taxes on it. And again, can't say it enough, highlighted it. Make sure you keep your beneficiary designations and titles up to date to avoid probate and reduce delays. All right, so these have not taken effect yet, but I thought it would be really good for me to mention a few of the changes that can affect seniors, et cetera, with the bill that's being proposed right now. So they are talking about extending the 2017 tax cuts and estate tax limits. Also discussing increasing the SALT deduction, which is the local tax deduction, such as what you can deduct as far as property taxes or state or local taxes. That's currently 10,000. They're talking about increasing it to 40,000 for people under set income limits. If you're still working and you work overtime, there could be overtime pay tax exemption. And then they're also discussing increasing the standard deduction, which I've listed here. Also a senior deduction. So going up to 4,000. There has not been anything said about taking away the Social Security taxes as of yet. So, key takeaways. Taxes don't end at retirement, they just change. If you have poor planning, you may have higher taxes and Medicare premiums. And really the bottom line is a tax smart strategy is essential. If your advisor's not talking about this, then they should be talking to you about this. And we're happy to give a second opinion on that as well. So our firm is full service as far as financial planning. Here we have all of the elements that you will find in a good comprehensive financial plan. It's not just about investments. It also encompasses income, taxes, your healthcare plan, and your legacy plan for your beneficiaries. Many of these items I just mentioned. So if you'd like to get some additional information or sit down with us to talk about planning on purpose, we'd be happy to have you. So again, here is the link for the no obligation conversation. And we'd love to talk to you. I love talking about this. I love teaching and educating, and I love really digging into people's scenarios and seeing how we can apply some of these things to your life to help save you money and, help your money last.
You hit the nail on the head, Grace. You did an awesome job today, and we really appreciate you taking time out of your busy day to help educate not only the Reliance client family, but friends, families, individuals, anybody else who might be interested in having a conversation with us or learning a little bit more about the work that we do with the families that we love spending time with so much. We had over 250 people on here today, so it was a great opportunity. Again, we thank Grace for her time, but also thank each and every one of you for taking time out of your busy weeks to join us here on Zoom virtually. We kept it under 40 minutes again, which is the goal, right? We want to give you some great quality information in a short amount of time. Again, we're going to send the replay out here in about 24 hours. You'll probably receive it around this time tomorrow. So if there's anything specific during this presentation you want to go back and reference, we'll send you a copy of that recording along with a link to this page on our website. But again, you can just go to RelianceFinancialPartners.com. You can hit that Meet With Us button. And if you have a question, you want to talk to Grace or any other member of our team, again, like she mentioned, we'd love to have the opportunity to do that. Other than that, Grace, I think that's everything. Any final words from you?
No, it was great. Thank you all for joining. I hope to see you all soon. And I hope everybody has a great day.
Yep.
All
Appreciate
right.
your time. Thanks so much.
Bye.